Hello everybody, welcome back to our channel and thanks for tuning in. This video will be slightly longer than usual, but here there is value information for you to identify when gold is becoming overvalued and when you should reduce some of your gold positions, rebalancing your portfolio. Also, we'll do an overview on how dividend stocks work and how you can boost your income and even retirement by adding high dividend stocks to your portfolio. I know some people here watching this video have great knowledge of investment, but some of other viewers are first-time investors, so I will keep it simple. About physical gold is to consider that this is your savings account out of the banking financial system. Savings because it keeps its purchasing power better than any currency in world's history, and out of the system because you can have some gold coins, gold bars, or even other gold objects in your closet at home or in a private vault. So it's safe because it maintains purchasing power throughout family generations, and because you can use even if the world's economic system, internet, electrical power and everything else shuts down. But gold is not a currency, and one day you might need to sell your gold to deploy some currency for whatever reason you need. Just remember that once you trade your gold, you will be using your gold to buy back the fiat currencies, dollar, euros, British pound, Australian dollar, or whatever currency you need to use. Of course, the best time to sell gold or any asset is when this asset is overvalued. If we look in history, for instance, in the 70s when the price of gold went up from $35 to $800 an ounce, we can say that $800 more than 40 years ago was an overvalued price for gold. While in my case, I would trade my gold to high dividend stocks when gold is overvalued. And normally gold is overvalued when stocks are undervalued. But how and when we will know that gold is under or overvalued? We probably wouldn't know if gold is overvalued measuring against fiat currencies such as dollar, euro, or any other currency that devalues year after year. Now let's look at some charts. Here is the performance of the Dow Jones since the year of 1900. Despite the Great Depression of 1930, the performance of the Dow Jones kept going higher consistently, and it was always making new all-time highs, correct? Yes, but this performance is measured against a currency that devalues constantly. This specific chart measures the Dow Jones, or better saying, the Dow Jones against the dollar. Let me show you this. This is a historical price of the Dow Jones measured against gold, also since the year of 1900. In other words, this chart represents the Dow to gold ratio. The Dow to gold ratio indicates how many ounces of gold you need to buy the Dow Jones, or one share of every company that listed in the Dow Jones. The ratio is simply calculated by dividing the points of the Dow Jones by the price of an ounce of gold in US dollars. This chart provides a little more than 100 years of information, but we can clearly see the difference when the Dow Jones is measured against gold or against the dollar. We can see three historical peaks here that shows that the stocks were overvalued in relation to gold. First peak in 1929. Back then, you would need 18.3 ounces of gold to buy the Dow Jones. Second peak in 1966, you would need 27.85 ounces of gold to buy the Dow Jones. The third peak was in 1999 during the dot-com bubble, and back then you would need 41.6 ounces of gold to buy the Dow Jones. Now, the analysis gets interesting because the data shows that it happens in cycles and follows a pattern. So here we go. From the first peak to the second peak, there was a gap of 37 years. From the second peak to the third peak took 33 years. So from peak to peak, there is an average of 35 years in between for the stocks to be in a bubble or overvalued in relation to gold. Other information is that from peak to peak, there is an increase of approximately 50% in the number of ounces of gold that you will need to use to buy the Dow Jones, 18.3 ounces in 1929, 27.85 ounces in 1966, and 41.6 ounces in 1999. Moving on, After every peak, there is a trough. The first one was in 1933, the second one in 1980. In these troughs, either gold was overvalued in relation to stocks or stocks undervalued in relation to gold. In 1933, we would need only 1.94 ounces of gold to buy the Dow Jones, or one share of every company listed there. On the second trough in 1980, we would need even less gold to buy the Dow Jones, only 1.3 ounces of gold. People who study this chart advises that the troughs happen in a cycle of 47 years. And if the last trough happened in 1980, by adding 47 years to it, we can forecast that the next time gold will be overvalued in relation to stocks will be in the year of 2027. Obviously, give and take, could be 2 years earlier or 2 years later, but should be around 2027. The Dow to gold ratio today is 18, and it's coming down from the highs of 41.6 in 1999. By historical data, the Dow to gold ratio could be around 1, so mean 1 ounce of gold to buy the Dow Jones in 2027. The Dow Jones is at 34,500 points at the recording time of this video. What we don't know is if gold would catch up, for instance, to $34,500 an ounce to equal the points of the Dow Jones, or if the Dow Jones will crash to equal the price of gold that's at the moment at $1,900. Other possibility is that the Dow and the gold will meet some point in the middle. Regardless if the Dow Jones will crash so much or gold skyrockets, when the rate gets lower, our gold will have a tremendous purchasing power in relation to the stocks, and I will trade most of my gold for high dividend stocks. To conclude, whenever the rate is nearing 5 or lower, I will start selling gold in tranches and buying stocks as gold will be overvalued again. I expect this to happen around 2027, about 6 years from now. It's interesting that if you consider the length of the past bull markets in gold and apply to today's bull market, it also indicates that the peak in gold prices will be some point between the years of 2026 and 2027. As I mentioned, I will trade some of my gold to high dividend stocks when this rate becomes favorable to do so. Until then, I have basically half of my portfolio already in high dividend stocks and the rest in physical gold and silver. In further video, as I promised, I'll talk about high dividend stocks, how to pick them, when to buy, and how to increase your income and even your retirement from it. But the video of today was about when to sell gold. I hope you enjoyed this video. If it was valuable to you, please go ahead, click on the like button and share if you like. This will complete the video for today. Thanks for watching, protect your wealth, stay safe, take care.